Welcome everybody to this video where I'm going to be talking about deferred tax and the intersection with IFRS 16, the Leases standard. Now, in this video, what I want to tackle specifically is our ultimate favorite, the paragraph 15 exemption. And I want to talk about how this applies when we are thinking about how to account for deferred tax when it comes to the right of use asset and the lease liability. Okay, so just a bit of a recap. Let's just look at paragraph 15. So paragraph 15 deals with taxable temporary differences. Now, something that we often forget is that the opposite, right, which is the deductible temporary differences, the exact same thing is happening in paragraph 24. So when I talk about the paragraph 15 exemption, know that I mean both. I mean both of them. Okay, so just to understand then, what does paragraph 15 and 24, what do they say? So essentially, it comes down to this, right? Whenever there are taxable temporary differences, we are going to provide for deferred tax on those taxable temporary differences. However, there are certain exceptions. So the first exception is if it is goodwill, then we do not provide any deferred tax. Now, when it comes to the initial recognition of an asset or liability, then there are three things that we need to satisfy in order to not have deferred tax on the transaction. So the first thing is it must not be in a business combination. Okay, and when we're thinking about leases, typically that is the case because we're looking at the financial statement level, right? So we're all good to go. Then at the time of the transaction, it must affect neither accounting profit nor taxable profit. Now, how do we affect accounting profit? We affect this by recognizing either an income or an expense. Okay, and the way that we affect our tax profit is through having perhaps what's going on there? By perhaps having an inclusion, okay, in gross income or an immediate deduction. Okay, and so if you have either of these two things happening on initial recognition, then you are going to be affecting tax profit, and then you cannot be within paragraph 15. Now, the third criteria is that at the time of the transaction, it does not give rise to equal taxable and deductible temporary differences. And so if you are creating an equal deductible temporary difference for your taxable temporary difference that arises, then you are not within paragraph 15 exemption. Then you have to go and provide for deferred tax. Okay, and then as it relates to the deductible temporary differences, which is paragraph 24, you can see here that it's got exactly the same criteria, okay, except it has this additional, limitation of there being probable future tax profits, okay, but that's dealing with other stuff, right? And so we're just interested in this exemption criteria as it relates to the initial recognition of either an asset or a liability. Now, in this question, what I want to do is I want to look at a simple example. This example is adapted from the scenario in the illustrative example 8 of IAS 12. So if you're in the test or the exam and you need to just go and refer to this example, it is in part B of your handbook. Okay, but this one, I've just adapted the numbers slightly. Okay, so in this question, we have a lease term that is 5 years, and then the entity was required to make an advance lease payment of 15,000, and they incurred initial direct costs on the lease of 5,000, and the annual lease payment is 100,000, and this is going to be paid in arrears. Okay, so at the end of the year, and they have an incremental borrowing rate of 12%, and the tax rate that we're using in this question is 27%. Now, let's just look at what IFRS 16 says. Okay, so IFRS 16, we know that when we are dealing with a lessee, you're going to, on the inception of the lease, recognize a right of use asset and a lease liability. And so as it relates to the lease liability, what this is effectively, it's the present value of all of the lease payments that have not been paid to date. Okay, and so you're going to take them and you're going to discount them at the interest rate implicit in the lease. And if you are not able to determine the interest interest rate implicit in the lease, then you are going to use the incremental borrowing rate. Now, just a reminder, the interest implicit is the lease is the interest rate that present values the future lease payments to the fair value of the underlying asset, right? And so in this case, we don't have that value, so we're going to use the lessee's incremental borrowing rate. Okay, now that is how we determine the lease liability. Now, when it comes to the right of use asset, okay, what IFRS 16 tells us is that with the right of use asset, we are going to have, first and foremost, the initial amount of the lease liability. So whatever the lease liability was over here, this is going to be included in the right of use asset. But also we're going to capitalize any lease payments that have been paid before the time and any initial costs, any initial direct costs. So I'm highlighting this specifically because that means for our question here, the 15,000, that is going to be capitalized to the right of use asset, and the initial direct costs are going to be capitalized to the right of use asset as well. Okay, so when you think about it then, at the initial recognition, if we try and figure out what of the present value of the lease liability is here, and we could actually do that. So if we put that into our calculator, where N is 5, the payment is 100,000. So let me just maybe change my color over here so I can write over it. So this would be N, this would be your payment, and then this would be your interest rate, and then you will get to a present value of, oopsie, what just happened? Oh, I think it is, oh, let me get my own number. Something just disappeared on my screen, sorry. So the present value there is 360 for 78. Okay, so that is the present value of the lease liability. So on initial recognition, the lease liability is going to be this amount. Okay, that's your lease liability. And then the right of use asset would be that lease liability plus the 15,000 plus the 5,000. So the right of use asset then would be 380,478. That's effectively what's going to happen. Now, when you think about the deferred tax, okay, when we are calculating deferred tax, what I want us to do is think about what happens at initial recognition. So when we are doing I'm going to scoot over here to my calculation for the deferred tax. Okay, so when you're thinking about what happens at initial recognition, we want to think about, what is the carrying amount at initial recognition of this asset and the tax consequences. Now, why is initial recognition so important? Because if we go back to paragraph 15, okay, when we are trying to assess whether an asset is going to be exempt from deferred tax, we always think about what happened at initial recognition. And if it was exempt at initial recognition, that means that subsequently it's always going to be exempt from deferred tax, right? Now, even though at the end of the year, when you get to the end of the year, you are going to have a different right of use asset and lease liability. If it was exempt at initial recognition, it is always going to be exempt. So if we just think about the lease liability for a second, the 364.78. Okay, so the carrying amount of the lease liability is 360.478. So that is what we have in terms of the lease liability. Now, from a tax perspective, what is our tax base? We know that this represents the future lease payments, and the future lease payments are all going to be deducted from a tax perspective. So for a liability, the tax base is carrying amount minus future deductions. So that means that there is a zero tax base. So that would then give us a deductible temporary difference of 360,000. Now, before we jump into the application of paragraph 15, right, let's just circle back then to the lease asset, the right of use asset. Now, the right of use asset, we said that the right of use asset is 380,478, okay? But when we think about the right of use asset from a tax perspective, we have to separate it into the underlying components. Why? because each of them have a different tax impact, right? So when you think about the advance lease payment of 15,000, that advance lease payment has already been granted as a deduction. So we are capitalizing it as an asset, but we've already been granted a deduction, so there are no future deductions. So that has a tax base then of 0. Similarly, when we think about the direct costs have been capitalized as an asset on initial recognition, and they've already been deducted from a tax perspective, so there is no tax base, right? And then we can think about the initial amount of the lease liability, which then is 360,478. Now, for this one, there have been no deductions because the lease liability, right, when we pay the lease payments, that's going to be subject to deductions. But as we think about asset, the tax deductions for the asset are going to go to the owner of the asset. So from our perspective as the entity that is the lessee, we do not get any allowances as it relates to this right of use asset. So you can see here why I've split out the 3 components, because each 3 of them, I mean, while the tax base is 0 in all cases, it's 0 for different reasons, right? In the first 2 cases, the tax base is 0 because there have already been deductions granted. And in the second case, the tax base is 0. In the third case, the tax base is 0 because there are going to be no deductions granted because we do not own the underlying asset. So that's going to give rise to temporary differences there of 15,000, 5,000, and then 364,78. Okay, so when we then think of, let's look at this first taxable temporary difference here of 15,000. So does the criteria of paragraph 15 apply? Okay, so I'm going to go up over here. Let's go to paragraph 15. So was this in a business combination? No, it wasn't. So we meet that criteria. Okay, at the time of the transaction, it must affect neither accounting profit nor tax profit. So do we meet that criteria? Well, no, we don't. Okay, so we don't meet it because when we paid the lease payment, we've already gotten a deduction from our taxable profit. So it did impact our tax profit, so we fail on that criteria. So because we fail on that criteria, we have to then account for deferred tax. So we're going to have deferred tax here, 27%, which is 4,050. Okay, then let's think of the initial direct costs. So let's go back up here. And I'm going to change the color of my pen again. And so we're going to ask ourselves again, with the initial direct cost, is this in a business combination? No, it isn't. So we pass that criteria. At the time of the transaction, affected neither accounting profit nor tax profit. Again, we fail over here. Why? Because when we pay the initial direct costs, we've already received a deduction. So because we fail there, we have to go and provide for deferred tax. So that gives us deferred tax liability there of 1,350. And now then let's think about the lease liability, right? The initial amount of the lease liability that's been capitalized to the right of use asset, the 360. Okay, so if we go back up here, okay, let's see. I should change the color of my pen. Let's make it purple. Okay, so is this in a business combination? No, it's not. So we meet that criteria. See what happened? Okay, so we meet that criteria. Now, at the time of transaction, it affects neither accounting profit nor tax profit. Okay, so if you think about that portion of the right of use asset, when we recognize that 360,000, we would have said debit a right of use asset and then credit a lease liability. So we're debiting an asset and we're crediting a liability, which means we are not affecting accounting profit. So that's correct. We meet that part. As it relates to taxable profit, when we recognize the right of use asset, we haven't received any deductions yet because the deductions for the lease payment are only going to be coming in the future and we don't get any write-off for the asset. So there is no impact on the tax profit. So we also meet that criteria. Okay, so this is looking good. We've met the first 2 points so far. Now the third one, at the time of the transaction, does not give rise to equal taxable and deductible temporary differences, right? And this is where it falls apart, because when you look at this taxable temporary difference that is being created over here, that taxable temporary difference is creating an equal deductible temporary difference. And because you have these two happening at the same time, it means you are going to have to provide for deferred tax. So that will be 97,329 and 97,329 over there. So because we don't meet the criteria in paragraph 15, we then have to provide for deferred tax. Okay. Now, I think something that we probably just need to think about, right, and take a step back with this, is that think about why we have deferred tax. So we have deferred tax because what we're trying to do is we are trying to account for differences in the way we have recognized something from an accounting perspective and the way it is going to be recognized from a tax perspective. And to the extent that these differences are temporary because they are just timing differences, we can then provide for deferred tax. Now, if you think about from an accounting perspective, right, as it relates to this leased asset, as you depreciate this right of use asset, right, and even the liability that you've recognized, all of this eventually is going to hit your income statement because we are going to be writing off the entire amount. It's going to be expensed to our income statement at the end of the lease, right? And as it relates to the lease payments that we make from a tax perspective, we are also going to be able to claim all of the tax from a tax perspective, all of the deductions, for the leases from a tax perspective. So we agree that this thing is going to be written off over time from an accounting perspective. SARS agrees that it's going to be written off at the end eventually once the payments happen. So the only difference in between is a timing difference. And because that exists, there should be deferred tax. And we see that coming through in the answer we have over here. Now think back to when you did deferred tax, then you first saw the paragraph 15 exemption. Think about what happened, right? You had a building that wasn't being written off from a tax perspective. From an accounting perspective, what was happening? You were depreciating that building. Why? Because you were allocating, the economic benefits that you're consuming over the useful life. But from a tax perspective, no allowances were granted. So the tax man doesn't actually think that this building is an expense to you. Whereas from an accounting perspective, you do think that this is an expense. And those two differences can never be reconciled because even in 10 years' time, you are still thinking that this is an expense. And the tax man is still saying, no, this building is not an expense to you. So that is not a timing difference. It's not a temporary difference because it means you and SARS are never going to agree as to whether or not this building should be written off. And that is then what we call a permanent difference. And in that situation, then there should be no deferred tax because there's nothing that is going to be resolving over time. And so I hope that this video has clarified for you how the deferred tax works. And remember, if you get stuck, firstly, you can go back to the beginning of this video, watch it again, or go watch some of my other videos. But also make sure that you read through the illustrative example in IAS 12, in part B of your handbook, it's example 8, so that you are comfortable with why it is that we provide for deferred tax. Okay, so that's all from my side, and I will see you in the next video. Thanks and bye.